Today's Wall Street Journal. We're breaking down the biggest business stories of the day, what happened, why it matters, and where the incentives really are. First article from Journal: Warren is a very hard act to follow. In Greg Abel's first letter as chief executive of Berkshire Hathaway, tells you almost everything you need to know about what this moment really is. It's not a personality change, it's a systems test. Berkshire, as described in this issue of the Wall Street Journal, is entering the phase every great compounder eventually hits: the era after the founder. It's the most fragile phase in the life of a business. Berkshire is interesting not because of any one deal, but because it is one of the few public companies that has tried to institutionalize rational capital allocation as a culture, not just a one-man skill, and now the person who built that culture has stepped down as CEO. The question that matters is simple: can a system built by one extraordinary allocator keep compounding without him? Here's what Abel is signaling. He says he intends to stick with what worked for his predecessor. He doesn't show up with a reinvention story, or a pivot, or a new chapter narrative. He is explicitly choosing continuity over ego. That is a capital allocation decision in disguise. He is choosing to allocate his political capital, his credibility, to preserving a framework, instead of branding himself. On screen, you'd be seeing text from the Wall Street Journal explaining how Berkshire's new chief, in his first letter in this role, emphasized staying with the playbook that worked under Warren Buffett. You'd also see a brief description of operating earnings, down sharply in the most recent quarter, and a reminder that Berkshire stock, which hit a record in the hundreds of thousands of dollars per Class A share last year, has underperformed the S&P 500 since that peak. That visual matters because it captures the temptation. When your stock lags the index and operating earnings fall, the market screams for action. Do something big. Make a move. Prove you're different. Abel is resisting that. That's not passive. That's discipline. The structure of this year's annual meeting reinforces the same message. Instead of the familiar image of Warren Buffett and Charlie Munger taking questions for hours, the first session will be Greg Abel and Ajit Jain, the men who oversee the operating businesses and the insurance engine. The second will feature the head of BNSF and the new leader responsible for a portfolio of consumer, service, and retail businesses. The spotlight is moving from stock picking to operating. In other words, Berkshire is deliberately recentering the story on operators and underwriters, not on a single iconic investor. That's exactly what you want to see if you believe the real asset here is the machine, not the man. For us, as value investors, Berkshire is the benchmark question. Are we investing in a portfolio of assets and securities that happens to be wrapped in Berkshire? Or are we investing in an institutionalized decision process? If it's the former, the departure of Buffett is catastrophic. If it's the latter, then the critical variable is whether Abel can protect the culture from the subtle pressures that come with time, size, and a different personality at the top. Most conglomerates fail this test. They start rational and end up empire building. They chase growth for its own sake, make acquisitions to signal activity, and gradually dilute the return on capital. Berkshire is trying to dodge that fate by doing something that sounds boring. Keep doing what worked. Boring is hard when everyone is watching you. Moving to next title. Now, contrast that with the story of Blue Owl Capital. The founders, Doug Ostrover and Mark Lipschultz, did what we all say we want founders to do. They saw an opening: private credit, lending directly to companies outside the banking system. They built a powerhouse. They focused early on software lending. They leaned into artificial intelligence and digital infrastructure. They raised a massive amount of capital from individual investors, not just institutions. And they personally became billionaires, buying a hockey team, a slice of an NFL franchise, high-end real estate. This is the Wall Street Journal, not a puff piece. The article maps out how those decisions, which looked brilliant on the way up, have now turned into vulnerabilities. Investor sentiment has shifted. The firm's market value has dropped by tens of billions over roughly a year. Shares of private credit peers, Apollo, Blackstone, Ares, KKR, are down more than a quarter, and Blue Owl's stock has been hit even harder. The foundations of the empire are cracking. On screen right now, I want you to picture the chart the journal includes: a line for the S&P 500, and below it, lines for the major private credit players, all sagging, with Blue Owl's line sliding from the low 20s into the teens. Next to it, another chart showing Blue Owl's own share price rising through 2021 and 2022, then rolling over as fears around software and AI hit. Those visuals are evidence of a simple truth. Capital markets eventually recalibrate even the most exciting narratives. Let's do the decision autopsy. Blue Owl made three big allocation choices. First, they concentrated heavily in technology lending, especially software. One of their key funds, Blue Owl Technology Finance, had more than half its assets in software and tech services. For years, that looked brilliant. Software revenue was sticky, growth was solid, and defaults were low. In the pre-AI era, this was perceived as a safe, yield-rich niche. Second, they leaned into individual investors. About 40% of their $300+ billion in assets under management comes from individuals. That's a staggering retail share for this industry. It looked like a genius distribution strategy. Semi-liquid funds with attractive yields, marketed to wealthy individuals through financial advisors at places like Morgan Stanley and UBS. Third, they used their own surging stock as collateral. At the peak, the founders had pledged around $2 billion worth of shares to lenders. That's leverage on top of leverage, a lending platform funded partly by retail, with founders borrowing personally against their equity. What was expected? That software loans would remain safe and prized. That individual investors would behave like sticky institutions, accepting limited liquidity in exchange for yield. That the stock would trend up or sideways, making personal borrowing against it a harmless optimization. What actually happened? AI changed the narrative around software. Markets started asking, which of these companies are about to see their business models disrupted by the very technology you're betting on? At the same time, general jitters in credit led some private credit funds to mark down loans. Confidence eroded. Individual investors, more reactive than pension funds, began asking for their money back. The journal describes how one of Blue Owl's older semi-liquid funds for individuals was supposed to be merged into a publicly traded vehicle. The idea? Give investors tradable shares, let them exit via the market. But the public fund's shares were trading at a discount to the private fund's stated value. That meant investors in the old fund were staring at an immediate loss in the mid-teens % range if the deal went through. Management launched the merger anyway, misjudged the backlash, then had to cancel. A trickle of redemption requests turned into a wave. In one technology fund, owners of about 15% of the shares asked to cash out. The structure allowed Blue Owl to cap redemptions at 5% per quarter, but instead of using that gate, they paid out the full 15% in January to show strength. That's what success carried too far looks like. The same impulse that drove them to scale quickly drove them to over-accommodate at exactly the wrong time. They tried to outmuscle the market with generosity, and the market read it as weakness. Then they tried to accelerate the wind down of the old fund by selling roughly $600 million of loans for top dollar. That allowed them to return about 30% of investors' capital quickly, but they didn't clearly spell out what remained in the portfolio or how those loans were valued. The stock fell again. Uncertainty is poison in credit. Meanwhile, the founders' personal leverage, borrowing against their shares, suddenly mattered. If the stock falls far enough, margin calls are not just a personal issue. They send a signal to the market that insiders might be forced sellers. Blue Owl says the loans are over-collateralized and that the founders haven't sold stock. That may be true, but in terms of incentives, the founders are no longer the pure long-term owners they once were. They're owners with personal finance constraints attached to the company's equity price. The inflection point here wasn't one bad quarter. It was the moment the capital structure no longer matched the psychology of the investor base. Tech-heavy exposure, retail investors, semi-liquid funds, personal margin loans, and rising AI uncertainty. That is a bundle of risk that only looks safe in hindsight. For us, the lesson is stark. Don't just analyze the borrowers. Analyze the lenders as businesses. Ask, who are their own capital providers? What liquidity promises have they made? How much of management's net worth is tied up, and in what form? Most failures in financial businesses come from success carried too far, too much concentration, too much leverage, too generous an offer to clients, all built on an environment that was assumed to be permanent. Moving to next title. Now let's look at something that seems softer but is actually about the same thing. Reese's and Hershey. This article from the Wall Street Journal profiles Brad Reese, the 70-year-old grandson of H.B. Reese, the man who invented the peanut butter cup. Hershey now owns the brand. Brad walks around West Palm Beach in a bright orange Reese's shirt, promoting the candy, talking to strangers, acting like a one-man street team. On good days, he's a brand evangelist. On bad days, he's a very public critic of Hershey. He's the central figure here, not because he controls capital, but because he embodies the original founder's intent. In his mind, he is the defender of the family brand. That's his role, steward of the promise his grandfather made to consumers, with that flavor, that texture, that orange wrapper. Listen to what he pushes for. He wants Hershey to advertise Reese's Puffs cereal, made by General Mills, on its own site, because it's an extension of the brand. He suggests a Reese's branded credit card. He wants more advertising spend in Europe. And, above all, he is obsessed with ingredients. Any change, any quiet substitution, he believes, is a betrayal that will erode consumer trust in Reese's. On screen, you'd be seeing his photo in the Journal. Smiling, orange shirt, Reese's logo prominent. You'd see pull quotes about how Hershey ruined his fun, and snippets from his letters to Hershey executives on Valentine's Day accusing them of swapping ingredients in ways that betray the brand. What's going on beneath the human interest is an incentives clash. Hershey is a public company. It has to allocate marketing budgets across a whole portfolio, manage input cost inflation, respond to health trends, and hit quarterly and annual numbers. The Reese's brand is one of its crown jewels, but it's still, in the spreadsheet, a line item in a category. Brad Reese doesn't care about the consolidated gross margin. He cares about whether the chocolate tastes like it did when his grandfather was alive. His incentives are emotional, almost reputational in a non-financial sense. Hershey's are financial, diversified, and time-bound by earning cycles. The risk for Hershey is slow decay. If they treat Reese's primarily as a cash cow to be optimized through small formulation tweaks and new line extensions, without deep regard for the founder's promise, they can still print money for years. But the brand can hollow out underneath them. Customers sense when a product is being managed for margin instead of loyalty, even if they can't articulate it. From an investor's lens, you want to identify when a brand owner is still acting like a steward rather than an exploiter. That's not sentimental. That's about the durability of the cash flow. Every time you see a founder family voice like Brad's ignored or mocked, ask whether the company is losing its connection to the original product truth. Moving to next title, How Businesses Shave Their Tariff Bills. This Wall Street Journal piece is about how U.S. companies are responding to broad-based tariffs, including a global 15% rate announced after a Supreme Court ruling, and higher targeted tariffs on certain goods. It's not about politics. It's about behavior under constraint. The key idea is simple. When government raises the nominal rate, businesses respond by lowering the base it applies to. If you can't escape the tariff, you can reframe what value you declare. The main tool is something called the first sale rule. In a typical import transaction, an American buyer might pay a foreign trading company $300 for a sofa. Under normal practice, you'd declare that $300 as the value and pay the tariff, say 50%, on it, which would be $150. But under a legal precedent from the 1980s, if you can trace the chain back and document that the original manufacturer sold that sofa to the trading company for $200, you can declare that $200 as the dutiable value. The tariff is still 50%, but now it's applied to $200 instead of $300. The duty drops to $100. Same sofa, same nominal tariff. Lower tax bill. On screen, you'd be seeing the Journal's breakdown of that example in plain language, and a simple inflation chart. Consumer prices over the past couple of years, showing overall inflation decelerating, and imported durable goods prices rising only a little over 1% during most of 2025. Despite all the tariff headlines. Why does that chart matter? Because it shows the system adapting. Economists predicted broad inflation from tariffs. Instead, we see companies using first sale rules to lower declared values, unbundling, shipping, insurance, and other non-dutiable components from the invoice, shifting production to lower tariff countries like Mexico, tweaking product composition to qualify for lower tariff categories, lobbying for exemptions on politically sensitive goods like smartphones and beef. The result is that a big chunk of the apparent tariff shock gets absorbed by supply chain re-engineering. One estimate in the article suggests importers avoided paying roughly $45 billion in tariffs in a single year through these tactics combined. The obvious lesson: never stop at the headline rate. The actual economic incidence of a tariff is a function of how nimble the players are. Large companies, with access to specialized trade lawyers and deep supplier relationships, can game the system legally. Small players often can't. They either eat the cost or raise prices. There's also a political feedback loop. A bipartisan pair of senators has introduced a bill to kill the first sale rule, backed by the administration's trade advisor, who argues that law firms are exploiting loopholes to undermine the tariff policy. When the state sees its rules being used too effectively, it tries to close them. For us, tariffs are rarely a reason to avoid a great operator. The real thing to underwrite is management's ability to treat regulation as another variable in the optimization function. Moving to next title, Data Centers and the Grid. Now to the invisible infrastructure. Data centers and the power grid. The journal describes how a cluster of data centers in Virginia suddenly dropped off the power grid on 2 separate occasions within months, threatening the stability of an already vulnerable system. This isn't just a tech story. It's a capital allocation story on a national scale. Data centers are the physical embodiment of the cloud, and the cloud is the physical embodiment of all the AI narratives you read. None of this is weightless. It's all electrons and concrete. On screen, you'd be seeing a chart of U.S. monthly data center construction spending, rising from under $1 billion a month to several billions. Next to that, you'd see projections from grid planners about how much electricity data centers could consume by 2030, numbers that move from single digits to the mid-teens percentage of total U.S. electricity. States like Virginia are already at the point where data centers are becoming one of the dominant loads on the system. The problem is not just volume, it's volatility and concentration. Volume, AI training runs, and high-density data centers draw huge continuous loads. Volatility. If a cluster disconnects or ramps down rapidly, it can create sudden drops in demand that destabilize the grid. Concentration. When you have multiple hyperscale centers in a small geographic area, you're concentrating systemic risk. Grid operators, as the article explains, have to plan for scenarios where they lose more than a couple of gigawatts of demand at once. That's a handful of big data centers going offline. If they haven't built the system to handle that, you can get cascading failures. Regulators and reliability councils are starting to respond, requiring data centers to smooth out their load changes, coordinating construction plans with utilities, and in some cases, warning that current trajectories are unsustainable without massive investment. The reality check here is that our favorite growth narratives, AI, streaming, cloud software, are perched on a physical system that moves much more slowly and is heavily regulated. If you own AI-exposed companies, you also own the risk that their power supply becomes a bottleneck or a political target. If you own utilities, you own the negotiation with hyperscale tenants over who pays for new capacity and how much flexibility those tenants must offer. From a value perspective, this is where you want to be early. Utilities and infrastructure owners that are pricing power correctly for AI demand. Data center landlords that structure contracts with real teeth around usage and flexibility. And tech companies that invest in their own generation and storage instead of free-riding on underbuilt grids. Moving to next title. Dutch Bros and the Economics of Sugar and Habit, listed in the Business Index. Let's go back to the consumer, but keep our investor hat on. The journal's piece on Dutch Bros lays out a fascinating picture of how a modern consumer chain builds a compounding machine. Dutch Bros is already the 3rd largest coffee chain in the U.S. when you look at locations and sales, behind Starbucks and Dunkin'. But that description misses the point, because this isn't really a coffee company in the old sense. Its core product is cold, customizable, sugary energy. Around 90% of drinks are served cold. Roughly a quarter of sales are from its proprietary Rebel energy drinks, brightly colored, layered beverages with syrups, foams, and sometimes toppings like boba. One of their large iced drinks, the Shark Attack Rebel, packs more than 100 grams of sugar. On screen, you'd see a photo of their chief marketing officer, Tana Davila, and a lineup of these neon drinks. You'd see notes about how their loyalty program captures about 70+% of all transactions, how their app drives ordering, and how customers share these creations on social media. This is a business built on 3 intertwined forms of capital allocation. Product capital? They've chosen to invest product development in cold, customizable drinks, 40+ flavors, mix-ins, cold foam, protein add-ons. That creates uniqueness and makes direct price comparisons harder. Starbucks can sell you a latte. Dutch Bros sells you your flavor. Data capital. With most transactions going through their loyalty program, They have granular data on what each customer orders, when, and with which add-ons. That lets them run precise promotions, target offers during slow day parts, and test new products with built-in audiences. Physical capital. They're opening stores aggressively but not randomly. They're building density in markets, creating local brand strength and operational efficiencies. They are adding food carefully, breakfast items that pair with drinks, without overcomplicating kitchens. The risk is obvious: sugar, health, regulation. 100+ grams of sugar in a single drink is not a long-term neutral. Competitors like Starbucks and McDonald's are already launching their own customizable energy and craft soda offerings. The economic engine Dutch Bros has built is powerful, but it's tied to a product profile that the culture may eventually turn against. As owners, you have to ask, does management see that risk? And are they investing now in lower sugar options, functional drinks, and brand positioning that can evolve from indulgent treat to something more sustainable? Or are they just riding the wave because comps are good? The worst fate for a great consumer concept is to mistake a phase of cultural indulgence for a permanent state of demand. Now, towards last article, layoffs, block, and fear of AI job wipeout. Finally, the AI story that actually matters to owners: jobs. The journal's business and finance section opens with a note that layoffs at Block, the fintech company, have added momentum to a growing backlash inside corporate America against the prospect of mass unemployment from AI tools. That's the first crack in the previously smooth narrative that AI is only about productivity and innovation. The article describes a striking shift in tone. Executives who once talked almost exclusively about efficiency gains are now publicly acknowledging the risk that aggressive AI adoption could lead to widespread job losses, social destabilization, and, ultimately, weaker demand for their own products. On screen, you'd be seeing quotes from leaders like Jamie Dimon at JP Morgan, who warns that if companies just lay off people to raise productivity, they can create societal problems even as their own numbers improve. You'd see references to market jitters, software stocks sliding, insurer valuations wobbling, even food delivery apps selling off, all traced back in part to anxiety about what a world of AI-driven white-collar job loss would look like. The article mentions a viral thought experiment circulated by a research shop, painting a picture where AI wipes out huge numbers of white-collar jobs, consumer spending collapses, and financial contagion spreads. That scenario resonates because it connects the micro-decision replace humans with software. To the macro consequence, destroy the customer base. There's also a counterpoint. Leaders like Jensen Huang at NVIDIA push back, calling some of the more extreme predictions illogical. Their argument is that AI will transform software, not erase it, and will create new categories of work. But the fact that this debate is happening in the business pages at all is the real signal. We've moved from AI as a pure margin lever to AI as a political and social variable that companies have to manage. From our perspective, this is where you separate shallow adopters from deep allocators. The shallow approach treats AI as a one-off cost-cutting project. The deep approach treats it as a multi-year capital allocation program. Use it to automate low-value tasks. Reinvest part of the savings into new products and services that create jobs elsewhere in the company. Invest in retraining so your own workforce can move up the value chain. Accept that some margin expansion should be traded for long-term demand stability and social license. The companies that do this will look less spectacular in the short term. Their incremental margins may be lower than the maximizers, but their franchises will likely be more resilient. Capital that compounds safely over 20 years is worth more than capital that spikes in year 2 and is regulated away in year 5. Lessons and ending. When you put all these stories together, Berkshire's succession, Blue Owl's stress, Brad Reese versus Hershey, tariff arbitrage, data center strain, Dutch Bros' sugar engine, AI-driven layoffs, you see the same pattern repeating. Founders and leaders win by exploiting an opening, a new structure of credit, an underpriced brand, a regulatory loophole, a craving in consumer behavior, a new technology. They build, they allocate, they succeed. Then the world moves. 3 lessons for us as value investors. First, incentives are the real balance sheet. Berkshire's system only works if Abel's incentives keep him anchored to rationality, not quarterly optics. Blue Owl's retail-heavy capital base and founders' personal leverage changed how they had to behave under stress. Hershey's managers are naturally pulled toward margin optimization. even when a founder's grandson is waving a flag about trust. Second, scale eventually tests your edge. Blue Owl's dominance in software lending, Dutch Bros' rapid store growth, the hyperscale data centers on the grid, what made them powerful also makes them dangerous if not managed with a view to second-order effects. Scale amplifies both skill and fragility. Third, success contains the seeds of failure when it becomes a script instead of a set of principles. Buffett's greatest contribution isn't stock picks, it's a set of principles about capital allocation. The question now is whether Berkshire can keep applying those principles in new conditions. Blue Owl applied its early playbook. Go big in tech, lean into retail, past the point where the environment supported it. Dutch Bros could do the same with sugar. We read the Wall Street Journal for facts, but as owners, we should also read it as a catalog of recurring patterns. Founders overreaching, operators underestimating complexity, politicians closing loopholes, infrastructure straining under new loads, management teams either respecting the limits of their own success or ignoring them. The core question every one of these stories asks is this: can this business, under these people, keep allocating capital intelligently as the world changes, or is it already optimized for a past that isn't coming back? The sentence I want you to remember is this: the real compounding doesn't happen in the stock chart. It happens in the quality of decisions. And the rarest edge in business is the humility to change the very behavior that made you successful before the world forces you to. This is Avi. Like and subscribe. On to the next.